It is Labor Week. And as you all know, Labor Week is the biggest week of the month in regards to moving interest rates. So let's unpack the data that we have so far. So on Tuesday, we had the JOLTS report, which is jobs openings, which basically summarizes how many jobs are on the market, layoffs, quits, hiring, things like that. Overall, this report has been rinse and repeat for about a year now. Basically shows that, hey, job openings are coming down. We've come down for over 2.5 years now. It's come down from its peak around 12 million, now around 7.1, 7.2 million. It has basically stabilized here, which is our pre-COVID numbers. So if you actually go and look at the chart, right, job openings was kind of doing this, and then guess what? COVID happened, it just spiked up, directly vertically up, and it has come down gradually, and now we are back to those pre-COVID levels, and it is completely stabilized. Quits, hiring, layoffs all remain the same. Layoffs are still incredibly low. Quits are incredibly low. Look at that. What does it signal? It basically signals that in this market, it is pretty simple. If you have a job, you are pretty much staying at that job. During COVID, you were seeing massive amount of people leave because there were a lot of people just throwing money at people. That has completely went away. So you are seeing if you have a job, they are staying at that job. And if you lose your job, it is much more difficult to find that job. But that is where Tuesday was. Then today, ADP came out, today, Wednesday, and it was a good day and it was a good mover for interest rates. So ADP came out and it had about 37,000 job openings, which was a huge miss. It was projected 110,000 job openings. And if you look at the last 12 months of ADP report, you can see job openings continuing to grind down month over month for the last 10 months, showing that labor is officially softening. Now, the big ones that we're watching is we are watching jobless claims and we are watching continued claims, right? This is a true data report here. This is one that comes out every single week. We know Labor Week is every month and it has a big driver of moving of interest rates, but continued claims and jobless claims comes out every single week Thursday, and this is what we really watch. So right now you can see continued claims rise. It's at 1.91 million, which is the highest it's been since 2021, showing that, again, yes, after 2 weeks, you then move into continued claims. Think about this. You lose your job, you file for unemployment insurance. Unemployment insurance, that is jobless claims. After a few weeks, you then move to continued claims. You're basically continuing to claim because you haven't been able to find a job. Continuing claims are at its highest level. Again, once again, showing that, yes, unfortunately, if you have lost your job, it is more difficult to find the job. Maybe it's more difficult to find the job that you want, that you desire, but we are seeing that. And jobless claims up to 240K, which is not anything concerning at this moment. We know it's going to rise seasonally for the next 6 to 8 weeks, right? We're probably going to get up to about 280,000, 300,000 jobless claims over the next 6 weeks, which would be positive, honestly, for interest rates as that number rises. But what we're looking at is we're looking at it from a year-over-year perspective. Are jobless claims higher this week than where they were at the same point last year, and then the previous year, and then the previous year, and then 2019? Go back to those pre-COVID numbers. And as of right now, you are seeing jobless claims higher. So you're seeing a weaker labor market as of week 22 compared to week 22 last year. So again, once again, showing signs of a weakening labor market. Nothing too crazy, just again, blinking yellow from that concept, right? So we still have 2 major reports that come out this week. Tomorrow, again, jobless claims will come out Thursday. And then we have the non-farm payroll, which is by far the biggest report of the month. It has the biggest move for interest rates. Overall, good signs for us. Good signs for mortgage interest rates coming down slightly this week. And as we continue to see a weaker labor market, yes, theoretically, this will affect interest rates in Q3 and in Q4. So positive signs ahead. If you have any questions, feel free to reach out.